Welcome to The Deep Dive, your shortcut to getting up to speed on the biggest financial stories.
Glad to be here.
Today, we're plunging into the latest from TransDigm Group Incorporated, that's ticker TDG. We're looking at their Q3 2025 earnings call, which actually happened intraday on August 5th.
Yeah, and this one definitely caused some waves. A really complex picture came out of this call.
Absolutely. And the market reaction was, well, pretty immediate and strong. So we're here to unpack all the key details and figure out what really matters underneath those headlines.
Exactly, because, on the surface, the numbers looked mixed, which led straight to that market disappointment we saw.
Right.
It really shows how investors can sometimes latch onto certain headline figures, even when other, arguably just as important, metrics are actually looking quite positive. You got to look deeper.
That's a perfect setup. We definitely need to explore that contrast. So let's start with those headline numbers for Q3 2025. Revenue first came in at $2.237 billion.
Which missed the street's estimates. They were looking for closer to $2.294 billion.
Exactly. A miss there. And the bottom line didn't escape either. GAAP earnings per share, EPS, that was $8.47. That's about a 6% miss against the roughly $9 estimate.
And even the adjusted number.
Same story. Adjusted non-GAAP EPS was $9.60. Analysts were expecting $9.90, so 30 miss there too. On paper, clear misses on both the top and bottom lines.
Right. And those misses, undoubtedly drove that first negative market reaction. But, and this is where it gets really interesting, it wasn't misses all the way down.
Okay.
The company reported exceptionally strong, what they call EBITDA-as-Defined, came in at $1.217 billion.
And remind us, EBITDA-as-Defined, that's TransDigm's specific way of looking at earnings before interest, taxes, depreciation, amortization with their own adjustments, right?
Exactly. It's how they measure their own performance internally. And that $1.217 billion figure, that's up a solid 11% year over year.
11%. Okay.
And maybe even more striking, the margin that went with it.
Yeah.
A remarkable 54.4%. That's up 110 basis points from last year.
Yeah, 54.4% margin. That's huge.
It really is. And net income was also up 7%, driven by 6.3% organic growth. So you see these really robust operational numbers kind of hiding behind those headline misses.
But despite those strong operational figures, that margin expansion you mentioned, the immediate market feeling was just disappointment. The stock took a big hit right away.
It did.
Why do you think investors focus so heavily on the revenue and EPS misses? It seems like they almost ignored the underlying profitability strength. What's that tell you about maybe the market mood right now?
Well, that's the million-dollar question, isn't it? Often, especially when things feel a bit uncertain, the market really craves that top-line growth. Predictability.
Yeah.
A revenue miss can immediately spark worries about demand, about the future, even if the company's squeezing out more profit from the sales it does make. For TransDigm, it really shows how short-term reactions can sometimes overshadow that deep operational strength they have. This is a company with a very specific playbook built for the long haul.
Okay, let's unpack that resilience then, because that 54.4% EBITDA margin is frankly staggering, especially when revenue missed. How does a company do that? How do they keep margins so high or even grow them when some parts of their sales are shrinking? What's the secret sauce there?
Yeah, it's a great question because it's core to their whole model. Unlike a lot of aerospace suppliers, TransDigm has a huge proportion of proprietary parts, often sole source. Think critical components where they're the only supplier.
Sure, airlines have to buy from them for certain things.
Especially in the aftermarket, yes. If a specific part needs replacing on an existing plane, often TransDigm is the only place to get it. That gives them enormous pricing power. So even if fewer new planes are being built, that OEM softness we saw, the massive global fleet of existing planes, still needs maintenance, repairs, upgrades, and they have to buy TransDigm's parts.
Okay, that makes sense.
Combine that with this relentless focus on what they call a value-based operating methodology, which is basically extreme discipline in cost control and efficiency, and they can manage costs and drive margins like few others can. They're masters at integrating the companies they buy and squeezing value out. It's almost an unparalleled level of internal control, even when facing hiccups like this OEM demand dip.
So the profitability isn't an accident. It's baked into the strategy. And beyond margins, the cash flow was strong too, right? Over $630 million in operating cash flow in the quarter.
Yeah, very robust. And they ended with nearly $2.8 billion in cash on hand.
Which gives them a lot of flexibility, I imagine. Key for their strategy.
Absolutely.
Yeah.
Cash is king for TransDigm. It fuels their M&A, lets them manage debt smartly. Now, getting into the specific market channels, this is where we saw some of those headwinds. Commercial original equipment manufacturer, OEM, revenue was actually down 7% in Q3 versus last year.
Okay, down 7%.
Management said it was softer than they expected, pointed mainly to lower build rates at, the big guys, Boeing and Airbus. And they also mentioned customer inventory destocking.
Meaning customers just used up parts they already had instead of ordering new ones.
Exactly. So management basically flagged this OEM softness as a temporary limiter on the quarter's results.
Okay, keyword there being temporary, but what's your take? Do these temporary blips in the OEM world sometimes stick around longer than expected? And how did the other parts of their business hold up?
That's the critical question. And honestly, the market reaction suggests there's some skepticism about how temporary it really is. But, contrasting with the OEM side, their commercial aftermarket segment, which is huge for TransDigm, that showed healthy 6% growth year over year.
Okay, aftermarket's still growing.
Yep. Within that, engine-related content was apparently very strong. Good performance in freight and interior submarkets, too. Management said, look, growth is moderating a bit here, but it's what we expected, and volumes are already back above pre-COVID levels.
So that aftermarket resilience, that's the buffer against the OEM swing.
It's the cornerstone, absolutely. And then you have defense. That market looked robust. Revenue grew about 13% compared to last year.
13% in defense, nice.
Yeah, pretty broad growth across different programs and customers, and they've mentioned healthy bookings supporting it. So you've got strong defense, resilient aftermarket, kind of balancing out that OEM dip. It's a portfolio effect.
It makes sense, a natural hedge, like you said. Okay, so despite that softer OEM picture, they updated their guidance for the full fiscal year, 2025. How did that shake out?
It was nuanced. They lowered the full-year sales guidance by $60 million. The new midpoint is $8.79 billion.
Okay, sales guidance down.
And they directly tied that reduction to those lower commercial OEM build rates and the inventory issues they saw in Q3. So confirming the impact there.
But here's where it gets interesting, right? Because despite cutting sales guidance.
Exactly. Despite the sales cut, they raised the guidance for that EBITDA-as-Defined metric, raised it by $40 million. New midpoint is $4.725 billion.
Wow.
Which keeps the expected margin around 53.8% for the full year. And adjusted EPS guidance also got a bump, up $0.27 to a midpoint of $36.74.
So less sales, but more profit expected for the year.
Precisely. And this updated guidance already includes the Servotronics acquisition they just closed, but it doesn't yet include the pending Simmons deal.
That divergence, cutting sales but raising profit, what does that signal about management's confidence? They must feel incredibly sure about their cost controls and operational leverage.
Immense confidence. It's a strong signal about their ability to manage expenses and extract profit, even if the top line takes a temporary hit. It's basically them saying, yeah, revenue might be a bit lighter, but we'll make more money anyway because we're that efficient.
So the new outlook for commercial OEM growth for the year is basically flat to low single digits now.
Correct, down from what they expected before. But critically, their growth assumptions for the commercial aftermarket and for defense haven't changed. Still expecting strength there, which reinforces the durability of those parts of the business.
Okay, let's pivot to their capital allocation and M&A. That's always a huge part of the TransDigm story.
Absolutely central.
Yeah.
They're sticking to their disciplined approach. Deployed over $900 million just this year to date on M&A.
That's significant capital going out the door. Fits with that private equity-like returns philosophy they talk about.
It does. They closed the Servotronics deal, about $138 million in cash. Servotronics makes servo valves for aerospace, and defense seems like a good proprietary fit.
Right.
And then the bigger one, they agreed to buy Goodrich's Simmons business from RTX for $765 million cash. Simmons is all about fuel and proximity sensing. Structural health monitoring really deepens TDG's content in critical flight systems.
And that Simmons business is expected to bring in about $350 million in revenue next year.
For calendar year 2025, yeah. And they expect that deal to close in Q4 of this fiscal year. So these aren't just random buys, they're very strategic, adding more proprietary content, more aftermarket potential.
And on the financing side, they've been busy too.
Very proactive. They refinanced about $2.65 billion of older debt that was due in 2027. Issued new notes, 6.375%, due way out in 2033. Basically pushed out their nearest major debt maturity, gives them breathing room.
Smart move.
And they also bought back $131 million of their own stock in Q3. Net debt to EBITDA ratio is now 4.9 times.
Which is well within their target range, right? They usually say 5 to 7 times is their comfort zone.
Exactly. So it shows very active, disciplined management of the balance sheet alongside the M&A. optimizing everything.
And speaking of management, this call was also notable because the CEO, Kevin Stein, is nearing his retirement.
Yeah, end of September. He reflected a bit on his 7+ years leading the company, expressed a lot of confidence in the CEO-elect, Mike Listman, to keep executing their value creation strategy.
Seems like a smooth transition planned.
Looks like it. They also announced some other internal promotions like Patrick Murphy to co-CEO. Seems like they're emphasizing continuity.
Okay, so putting it all together, what does this mean for you, the listener, tracking this company? Let's talk about the market's verdict first. That reaction was fast and pretty brutal.
Immediate and impactful is right. The share price, I think it dropped from around $4,450 down to $382 within like half an hour of the call starting.
Wow.
And it closed the day down almost 12%, 11.9% at $4,407. Volume was huge, like 4 times normal.
And even before the market opened, it was already indicating a drop.
Yeah, pre-market was down around 7%. And options activity showed what's called a put skew hitting a 1-year high.
Okay, put skew. Break that down for us. What does that signal about market sentiment when it hits a 1-year high?
Good question. So a high put skew basically means the demand and therefore the price for put options, which are bets the stock will go down, is unusually high compared to call options, which are bets will go up.
So lots of people betting on further declines.
Exactly. It's a clear sign that a strong bearish sentiment took hold. Traders were positioning for more downside. It really underscores how much the market zeroed in on that sales cut, even though profit guidance went up, drove that big double-digit drop.
It's almost like a psychological reaction, isn't it? The missed sales narrative just overpowered the better profits story.
Absolutely. Reminds you of that saying, the market can stay irrational longer than you could stay solvent. Sometimes the narrative just takes over, short term.
Definitely feels like the market saw the problem, the sales miss, rather than the solution, the margin strength, and looking bigger picture, industry-wise.
Well, the broader aerospace scene shows, civil aftermarket growth seems to be cooling off a bit, maybe moderating to high single digits. Defense demand still looks strong, but that OEM supply chain friction, that's a persistent headache across the sector, expected to linger into early 2026 probably.
So it's not just a TransDigm problem, it's wider.
Exactly. Which brings us back to management's view. They're calling the OEM destocking temporary, short-lived. They project a return to positive growth for commercial OEM sales in Q4.
But investors will be watching closely.
Oh, yeah. They'll want to see proof that normalization really happens by early next year. The market's waiting for that validation. These broader industry issues, like the supply chain stuff, they add uncertainty that even TransDigm's model can't totally avoid, but arguably they're built to handle it better than most.
Oh, let's talk about that enduring strategy then, and maybe what catalysts are out there. TransDigm's playbook hasn't really changed, has it? Focus on unique proprietary products, high aftermarket content, that super disciplined operating method, and smart, accretive M&A.
Still firmly intact. And their stated goal is pretty bold. Provide shareholders with private equity-like returns with the liquidity of a public market.
Explain that private equity-like returns bit. How does a public company achieve that?
It's really about their mindset. They aim for very high internal rates of return on their investments, especially acquisitions, just like a PE firm would.
Yeah.
They do it through that intense cost management, maximizing pricing on their unique parts, and buying companies they can quickly plug into their efficient operating system to boost profits fast.
And the liquidity part just means?
Just means you, the investor, can buy and sell the stock easily on the public market, unlike investing in a locked-up private equity fund. It's a powerful combo they aim for.
Makes sense. So looking ahead, say 6-12 months, what are the potential catalysts?
Okay, several things to watch. First, the closing of that Simmons acquisition. Then, updates on how well they're integrating it and achieving synergies. Second, those ongoing production ramps for the Airbus A321neo and the Boeing 787. Management thinks that alone could add, maybe 50 to 80 basis points to TDG's revenue growth eventually.
Okay.
Third, potentially a special dividend. They've done those before when their leverage gets back into their target zone, maybe around 6 times EBITDA.
Returning cash to shareholders.
Could happen. And then fundamentally, the upcoming full year results in November. That will be a huge test for validating that OEM rebound story the market is so focused on right now.
Got it. And overall sentiment, how did management sound and what are the banks and funds saying?
Management's tone, I'd call it cautious bullish. Confident in their execution, acknowledging the OEM challenges, but focused on the margin strength.
Okay.
On the buy side, we hear reports some funds are actually adding shares on this dip. Their thinking is, hey, the classic TDG margin story is still intact.
Interesting. Buying the dip.
But on the sell side, the analysts who cover the stock, views are more mixed. Some are sticking with outperform ratings, but others are trimming their price targets because of those near-term OEM headwinds.
Yeah.
So it's definitely a divided picture out there. Reflects the complexity.
Yeah, that mixed sentiment really mirrors the mixed results, doesn't it? A negative knee-jerk reaction, but maybe an undercurrent of belief in the long-term story for those willing to look past the immediate sales figures.
Precisely. Some see a temporary issue, others worry it might be more persistent.
All right, we've broken down the numbers, the strategy, the reaction. Let's shift gears just a bit now. And as always, a reminder, what follows is absolutely not financial advice. These are just speculative ideas, thought experiments, purely for illustration, okay? Meant to get you thinking. Do your own homework.
Definitely not advice, just batting around ideas.
So given this whole picture, the market hitting the stock hard on the sales miss despite the profit raise, that high put skew suggesting bearishness, what's an outrageous but plausible thought that comes to mind from all this?
Okay, here's one way to think about it, playing on that divergence. You could consider setting up a position that essentially bets on TransDigm stabilizing or recovering from this sharp drop. Maybe something like selling some out-of-the-money puts, which profits if the stock stays above a certain level.
Okay, betting on a floor, essentially.
Kind of. But then maybe you pair that with taking a short position in a different aerospace supplier. Specifically, one that's much more exposed to those challenged commercial OEM build rates, and critically, lacks TransDigm's huge high-margin aftermarket business and their M&A options.
So a relative value play, long TDG's resilience, short a more vulnerable competitor?
That's the idea. The thesis is the market overreacted to what TDG management calls temporary OEM issues. You're betting that TransDigm's consistent margin strength, fueled by those proprietary aftermarket parts and their smart M&A engine, will win out long-term over these shorter-term headwinds.
And shorting the more vulnerable OEM player acts as a hedge if the whole sector stays weak, but you're fundamentally betting TDG's specific business model will outperform when that OEM cycle eventually turns or normalizes.
Exactly. It's a bet on business model divergence in a tricky aerospace climate, leaning into that classic TDG margin story that some of those buy-side funds seem to be betting on right now.
Interesting way to frame it. Okay, let's recap. TransDigm's Q3 was definitely nuanced, showcased that incredible margin strength and smart M&A execution, but ran into headwinds on the commercial OEM sales side, falling short of expectations.
And the market reacted sharply to the sales miss, maybe overlooking the simultaneous profit guidance raise and the underlying operational muscle. It really highlights the current sensitivity to top-line figures.
So the big question left for you, the listener, to ponder is that OEM softness truly temporary, like management believes, or is this something more concerning?
And how will TransDigm's really unique business model, that strong aftermarket, the M&A discipline, navigate these cross currents and position them if or when that OEM recovery finally kicks in? It's a key moment for the stock in this story.
Definitely one to watch. As always, this deep dive was for informational purposes only. It is not financial advice. Please use these insights as a starting point for your own thorough research and analysis.
Do your homework.
Thanks for joining us on the deep dive.